Alrighty guys, let's talk about the option strategy known as the butterfly. Pretty stupid name for a trading strategy, but if it can make us some money, guys, it's something worth learning. So, one of the things that I love about options trading is that there's, so many different strategies you can use, guys, for really any kind of move you're looking for. So, for the sake of conversation here, let's say that a trader was under the mindset that the market is a little bit too extended and they're looking for a pullback to the 21 EMA. Now, I'm not saying this is going to happen, right? This is for the sake of the video. Don't go putting this trade on, right? But let's say a trader's looking for that typical reversion to the mean right back to the 21 EMA. Now, you can do a call credit spread. You can buy naked puts. But let's talk about the butterfly, guys. So keep in mind, the whole thought process of this given trade is that the market is going to pull back and then hold up support above that 21 EMA. That's the move you're looking for, and I'm going to show you guys how you could use the butterfly to potentially catch that move with a ridiculous risk reward, and I'm going to break down the butterfly strategy in a fashion that's, at least in my opinion, nice and simple to understand. So let's jump in here, guys, to the slideshow. Alright, so options butterfly strategy, we are going to do S&P 500 SPY March 29th expiration 121 put butterfly. All right? And you guys will understand what the 121 means here in just a second, but that's the name of this trade. It's a put butterfly. Remember, the trader is looking for a SPY to pull back to the daily 21 EMA by this coming Friday. This put butterfly is just one example of a strategy you could use to play such a move with a pretty off-the-charts risk reward. And again, this is just for the video, guys, not a trade suggestion. So don't go putting this on and yelling at me. But here's what we're going to do here, guys, for this butterfly. And I'll show you this on the platform in a second. We are going to buy one 292 strike put at about $2. We are going to sell two of the 288 puts at about $1.20 for a total of $240. And then we are going to buy a 284 put for 70 cents. For a total of $70. So we have gone long a 292 put and a 284 put, and we have sold short a 288 put. So a butterfly, guys, is a little bit, if you're familiar with debit spreads, it's a little bit like a debit spread. However, you're adding another leg to the position, right? You're adding another layer, and adding that third piece to the puzzle here, it allows you to go unbalanced, meaning you can sell two of the 288 puts, and then you can buy one 292, and then you can buy one 284. In a typical debit spread, it has to be even as far as how many contracts you're buying and you're selling. So that's what we're doing here, guys. So we're looking for a move down to the 21 EMA, and we're expecting the market to hold up right above 288. And again, guys, I'm going to keep repeating it. This is just for the sake of the video. That would be a nice healthy drop here for the market. And, it just so happens that here in the future session, we're up 1%. So obviously, this isn't a trade you would take. However, for the sake of conversation, it's a good example. So that's what we're looking for by this coming Friday. Reversion to the mean for the market to just simply pull back to the 21 and then hold up before making its next move. All right. So again, we would go to this Friday's expiration, which is May 29th. And you guys can see we already got the trade set up here. We're going to buy one of the 292 puts. So we're going long that put. We are going to short two contracts of the 288 put. So we're long this put. We are short two contracts of that put. And then we are going to go long one contract of the 284s. And to show you guys that here on the chart, if you want to look at, say, an hourly time frame, right? We have a long put up here at 292. We have the short puts at 288. And we have our long put at 284. So let's go back here to the chain. And now you see, guys, one of the benefits of this, right? There's a long list of benefits to a strategy like this. But if you were to do, 1, 2, 1, the position's only going to cost you $36. So I can't stress enough for you new options traders, while these strategies might seem a little bit overwhelming, if you take the time to kind of slowly learn them, with a smaller account, guys, you can still make some headway, and this strategy is just one example of it. This could cost you $38 to take the position, and of course you guys are all staring right now at the max profit, which is about $364, right? And that's not a glitch. That's the real risk reward. You're looking at about a 10-to-1 risk reward ratio. or should I say a 1 to 10, where you're risking $30 to make over $300. Now that's best case scenario. Does best case scenario happen every time? No, it doesn't. Is there the chance that every now and then you get pretty damn close? You know, when you're structuring these trades, guys, around something like a simple reversion to the mean, you can get pretty close sometimes. So if we kind of go look, right, at the chart here, and I just showed you guys the structure of this trade, we are long this put, we are short these puts, and then we are long these puts. Now here's the best case scenario, guys. The best case scenario is that leading up until Friday, right, leading into the close, the market has pulled back to the 21 EMA, and we are just hanging above 288. That is best case scenario. Somehow, some way, the market pulled back to the 21 EMA, and we're just a little bit, 281, 282. We are just above, 289, 290. If we happen to, leading into the close on Friday, day of expiration, hanging above 288, that's the absolute best case scenario. And that's where you can get pretty close to that ridiculous 10x return. And I'm going to show you guys how you would actually get that return. All right, so for that best case scenario, best case is that we pull back to the 21 EMA and we're hanging right above 288 leading into the close on Friday. Now, why is this the best case scenario? Well, let's take a look at what our options will be worth at that point. So it's 3:45, market closes in 15 minutes, it's the day of expiration, we're trading at about 289, right above that 21 EMA. Where would our options be? So if we were to fall, guys, right towards 282, our 292 put, which we are long, would be about 4 strikes in the money. And for the sake of conversation, we're going to make this really simple, right? We're long this 292 put. If we can get to 289, right near 288 by Friday, we're going to be 4 strikes in the money. 4 strikes in the money, guys, you're looking at about $4. So for the sake of conversation, let's just say that your option would double from $2 to about $4, and that's going to result in you making a profit of $200 on that given option. Now, in the same scenario, what about our 288 puts? We're 15 minutes away from expiration, and those puts, because we have not dropped below 288, are out the money. What happens to out the money options at expiration, guys? They're worthless. So those options, which will be just out the money, will have 0 value left, which is going to result in us collecting $240 of profit. And remember, we shorted 2 of those at $1.20 for a potential $240 that we can completely collect. So let's assume those go to 0. We're going to collect the $240 of profit right there. So the long put at 292 ends up going 4 strikes in the money. We get 100% return on that. We make a profit of $200. Our 288 puts, and remember, we shorted 2 of those. They're still out the money. They have 0 value left, which results in us collecting $240 of premium, right? So we make $240 of profit. Now our last option, guys, that 284 put, right? We close right above, say, 288. Our 284 put is also going to be pretty deep out the money. It's going to be absolutely worthless, no value left. So we will lose $70 on that option. So again, this is best case scenario, guys. If we were leading into close to be hanging just above 288, our 292 put is 4 strikes in the money. It has doubled. We got profit at $200. Our 288 puts, they are still out the money. They are worthless. We collect $240 of profit. Our 284 put is out the money. We eat the full loss, losing $70. Altogether, guys, you make $200 from your long 292 put. You collect $240 of premium from the short 288 puts. You lose $70 from the long 284 put for a total profit of $370. Now that is best case scenario, and that would be $370 of profit on a trade that, as you guys saw, is only going to require you $36 to initiate. Now, I don't want you guys to watch this video and think, holy shit, right? I'm going to start 10xing my money every week. That's the best case scenario, right? Is that you buy this thing for 36 cents and you sell it for $3.50. That's best case scenario, guys. And I'm not going to say that you can't get pretty close. I have had a couple of butterflies as of late doing this exact strategy here on the index that have gotten incredibly close. But I wouldn't take these trades with the mindset that you're looking for the 10x return. My mindset would be, guys, if you can get this thing for 30 cents, right? And say you got a smaller account and you're going to do, 1, 2, 1. You put in 36 bucks. I'm not of the mindset, guys, that you're sitting there holding on for the $300 profit. If that were to ever happen, that's awesome. However, with $36 of risk, you can make an easy 100%, 200%, right? Maybe even 300% return. You can buy these things, right? You can get your position at 36 cents. You can sell it for 70 cents, $1, $1.50. That's an incredible return. And that's going to take place, guys, the closer that thing gets to the option you sold leading into earnings, right? So as Friday's approaching, if we're falling, right, soon as you get under 292, that's when things can start cooking, because now your long put is in the money and going to hold its value through expiration, while your 288 put begins to lose value as it's out the money. So approach these trades, guys, if you begin to experiment them with the mindset of, hey, if I could double my money, if I could 2x it, even 3x it, that's really phenomenal. Best case scenario here is obviously attractive, but the last thing I want you guys to do is, see these numbers and then all of a sudden say, man, I'm going to go $3,000. I'm going to make 36 grand. Play smart, guys. But that's a brief introduction into the butterfly strategy. This given example was a put butterfly. And there you have it, guys. So if you want to learn more option strategies, be sure to subscribe. You can definitely check us out at focustrades.com, and I'll see you guys in the next lesson.